Okay, there's still one or two dribbling in, but I think in the interest of time, I'll kick off if I may. Welcome everyone to our Sustainability Reset Thought Leadership event. I'm really pleased to have Chris Dyatt and Jasper Crone with me from Sen. We'll be covering what investors expect this year and next year in sustainability and some practical steps you can take with your own disclosures, your own engagement to get ahead of what's happening. Before we kick off, I'd like to get some of your views, if I may. I promise this is the only session where I'll be asking you questions. However, there is a session at the end where you can ask us questions. So if you've got any questions as we go along, please have a think and ask them in the chat in the final session. So let's get a poll going. What I'd like to know is where you think sustainability is going for your organization in 2026 to 2027. Do you feel it's an opportunity for growth? Are there lots of opportunities through sustainability to grow financial performance? Is it a compliance or a hygiene factor? Is there going to be a neutral impact from sustainability, or could it even be a drag on growth over the next 12 to 18 months? Interested to get your opinions. I can see some viewpoints are already coming in. Give it a few more moments. Okay, looks like we're just about stabilized now. I'm delighted to say that it's roughly 50-50 split, slightly in favor actually of growth between growth and hygiene. So none of our attendees today think it's neutral or a drag on growth. Given it's a sustainability webinar, there might be a self-selected group there, but I'm delighted to say the balance is actually towards an opportunity for growth. I couldn't agree more. In fact, we've done some research into the FTSE 100 annual reporting, and that does seem to be the direction of travel. It's a real focus on value creation and how sustainability and ESG more broadly really drives financial value as well as broader stakeholder value. Thank you very much for your contributions there. As I say, please do keep your start getting questions in. There's a Q&A button. You can type in questions there, but we'll cover them at the end. So hopefully most of you know who we are, but obviously we've got some of Sen's attendees today, and Sen have got some of Positive Change Group Black Sun's attendees. So we'll just introduce ourselves really quickly. We are, of course, Black Sun, one of the foremost reporting, comms, digital and investor and sustainability advisory firms. We specialize in annual reporting, sustainability reporting, website, social, AI optimization, and all the ancillary services around that. And we are, of course, part of the Positive Change Group. About 3 or 4 years ago now, Black Sun combined with Stratton Craig, the storytelling, comms and copywriting agency, and People Made, the employer brand and culture advisors, to create a really rounded stakeholder engagement group. So whatever your needs are, hopefully we can either address them directly or we have good friends who can do it for you. With that, I'll pass to Chris to talk about Sen.
Thanks, Ian. Good morning, everyone. I hope everyone's had a good morning so far. So Sen is combining two businesses, an investor communications focused business and a sustainability consultancy. Happy to take offline any conversation anybody would like to have about what we do in more detail. But to give people a little bit of background about the investor communications business, because that's the business where we get a lot of information from the investor community. The business works with a wide range of both UK and internationally listed corporates, either as an outsourced but in-house investor relations team on specific projects like IPOs, capital markets days, perception studies, or in an interim cover role, maternity, paternity, or when there's a gap in the team. Our clients include 10 in the FTSE 350, as well as those in the smaller cap. And this allows us to have direct and regular access to investors, to sell-side analysts, and to lending banks. So every month we have hundreds of conversations which involve investor teams, the governance teams, and sustainability specialists in the world's largest financial institutions. So today I wanted to share with you what we're hearing, what has changed over time, and what we think comes next. So Ian, if you could turn to the next slide. So on the next slide, this is a very simplified timeline, but it provides what we think is a good snapshot of the changing approach to sustainability from an investor perspective. So back in 2019, 2020, we saw a significant step up in investor interest in ESG, with a growing demand for information, data, and answers from companies. It is fair to say at that time it was somewhat disorderly and somewhat frenetic, but that allowed investors to kind of start to understand the subject matter better for those who are kind of coming into it newer. This was followed by a major build out of databases and the baselining of portfolios, whilst companies, data providers, and investors expanded their sustainability teams. So there's lots of work going on to try and understand the subject matter and bring things together. The next stage in kind of 21, 22, we saw the attention shift to whether companies had set their right objectives, particularly around TCFD, climate risk, science-based targets, and net zero. These issues with investors were often raised in meetings alongside the broader ESG themes such as DE&I. So effectively, you'd gone from building out a kind of understanding and a level of information into questions being asked in investor meetings or written email requests, but it still was in a way that I describe as kind of quite unstructured, and there's a lack of understanding about a lot of the subject matter. What we've seen as we shift forwards 3, 4, 5 years into late 25 and into 2026 is we found from our perspective for the companies that we work for, investors asking more targeted questions linked to company specific exposures and very much more targeted. And also finding that investors are doing a lot more of their own analysis using the information that we as the corporate community are providing them. The sustainability teams within the investment firms are generally smaller and more focused now than they were 3 or 4 years ago, as they kind of built out probably too much during 2019, 2021. So whether you call this sustainability, resilience, operational risk, or non-financial risk management, the underlying issues are the same. The key point here is that it is wrong to think that investors no longer care. You may not be hearing from them so much, but they still do care. Their language is probably quieter, but the analysis has become more targeted and more commercial and more directly linked to the value creation. So what I wanted to do is provide a couple of examples for you to bring this to life and also give you a flavor for the types of questions that we are hearing from investors. So a medium-sized FTSE 250 that has a global footprint that is involved in the manufacturing of a product that we're all wearing on us today, which probably gives a clue to which the business is, has a plant or a number of plants in India. And a large top 10 investor sent a series of very targeted specific questions to understand the risks related to those sites in India and how they'd operate not in the next year, but over the next 5 to 20 years, understanding what higher temperatures and increasing water stress would do for those assets. More specifically, could that plant or those plants secure sufficient water, and was management actually reducing that exposure? The interaction there took several weeks. There were a significant amount of back and forth as the company was providing more information to that investor to get them comfortable that there wasn't a major risk with what is a major manufacturing hub for that particular business. And this is a very different conversation than the broader ESG questionnaires we were receiving 4 or 5 years ago, where it was just filling stuff in. Turning to another example, a large international fund management group, actually with a US bias, asked another company, a smaller cap in this case, so it is still impacting companies of a smaller size. This one's about 400, 500 million of market cap. They asked the company, which is involved in the residential construction, residential building products related business, how their products were going to help meet net zero in that area. Now, this relates to materials usage, the materials they're currently using, the materials that they are going to transition to, and the costs and benefits of the transition. And it wasn't at a very high level, it was at a much more specific level, wanting actual kind of detail behind that in terms of the numbers and the impact that's going to have. So these are two examples, but we have many more than that. And it is fair to say that we are seeing a lot more of these questions in 2026 after what was definitely a much quieter period in the second half of 2024 and throughout most of 2025. The trend is mainly coming from UK and European investors, but there are some US investors, as I mentioned, one of those examples is actually from a US investor, but the US investors are doing that on a much, much more quiet basis. They don't want it to be known publicly that they're still working on this stuff, given political implications and ramifications of doing so. And I think also it's worth understanding that often the labeling isn't around ESG and sustainability anymore. They've changed the language that they're using. It's much more about the business model, operational resilience, what are the future cash flow implications of this particular issue happening, whether it's disaster recovery. And ultimately, these things are impacting valuation. I think we'd also just like to reflect that alongside this, ESG data that you're putting together as sustainability representatives or company secretarial or communications people within companies, that ESG data is still being used by the institutions, and effectively they are ingesting it within their systems. So they're using it to track as part of their own stewardship and oversight obligations. They're using it in their own reporting, both regulatory and to their investors, and as part of their net zero ambitions if they still have them. And therefore, it is worth making sure that the data you are providing to the investor community is of the highest quality and as accurate as it possibly can be, because, as I said, it is still being used, even if they're not actively talking to you about it, talking to you about it. So these requirements have not gone away. So what do we think comes next? So we expect these trends to continue. The pendulum is swinging back the other way. We started to feel it will take a little bit of time. But what we'll find is that the questions will be narrower, the askers will be quieter, and it will be more real world focused than it has been 4 or 5 years ago. The companies and management teams that will handle this best will be those that translate sustainability into operational resilience, how it informs capital allocation decisions, and long-term competitiveness. Importantly, this matches the direction of travel for ESG rating agencies as well. For those who don't know, we're seeing advancements at the large rating agencies, which are going to impact or likely to impact the rating that you achieve. But it's also the direction of travel of regulation, which is not as heavy-handed as it has been, but it is still there, which is increasingly focused on non-financial risk management and business resilience. With that, I'll hand over to Jasper, who leads on a day-to-day basis our sustainability business, to talk about what other stakeholder groups are doing and seeing. Thank you.
Great, thanks, Chris. So yeah, we've seen that evolution in investors, and then just to broaden out on the other main stakeholders, Chris touched on ESG ratings. I mean, obviously that goes part and parcel with what investors are asking, but essentially it's more about performance now than disclosure. In the olden days, you could get your way to the top with the volume of information that you put out there, but increasingly that's more difficult as kind of relative performance of your key kind of metrics is forming a greater portion of your rating over time. So it's getting a bit more into the real world. Customers and consumers, the next bullet. I mean, this is really the underpin to our sustainability business over the period where, regulation went a bit quieter. And we've certainly seen that a continued increase in demand through company value chains, especially obviously in a B2B context. So some of these are just specific kind of bilateral discussions meeting a particular customer's requirements, but more often than not, there's a large player in the value chain that's kind of calling the shots at the bottom, and that's getting translated all the way through the businesses that are there. So this has taken quite a number of forms. In case of kind of just sort of reporting and activity, we've seen a software supplier to one of the FTSE 100 financials, having to report to EcoVadis, having to set a science-based target with the SBTi, and actually having to achieve a certain threshold grade within CDP. So a reasonably onerous set of conditions for what was actually quite a small business as a supplier to one of the leading financials in the UK. But even we're seeing the sort of complexity of what companies are asking increase. One of our clients is a supplier to an auto OEM. They had to, within an RFP kind of framework, they had to agree to deliver a certain part at below 7 kilos of embedded CO2 per unit, which was actually no problem, and no problem in demonstrating that. But the OEM was working to caps on all of their inputs, such that the overall vehicle was coming in below a sort of threshold embedded carbon figure. And we've seen within household products, not just on embedded carbon, but the requirement to deliver into retailers across a suite of kind of sustainability attributes, things that are made better in a more sort of sustainable way or a lower carbon way, things which are using more sustainable materials within their manufacture, and then goods which provide kind of sustainability benefits during their life, whether that's lower water use or energy efficiency relative to the sort of standard product. And lastly, that graphic there is a picture from the 2025 CBRE European Office Occupier Sentiment Survey, as it says. And I think the key here is that sustainability criteria is the number one issue, even above the building's actual amenities and space that buyers are looking for. So corporate occupiers, require their buildings to help them achieve their sustainability goals and net zero commitments. I suppose it's not really a major surprise, but if you take a step back and you think, well, if you're supplying real estate that doesn't have those attributes, then it's almost certainly going to trade at a discount to those that do, and/or suffer from higher vacancy rates. So, a real kind of commercial, direct commercial impact from that. The internal stakeholder, Chris touched on this around sort of resilience and risk management. It doesn't really, as we said, it doesn't really matter what it's called. We certainly see that come to the fore this year with the Iran conflict, which has raised or increased, investigations around energy security and self-generation, as Ukraine did a few years ago. And also, one of the key areas is really the supply chain. We live in a just-in-time world, and any disruption to that, whether it's COVID, but usually a more localized impact, is obviously needs investigating. We've seen companies also explore opportunities in this area. They can, if they feel that they've got a competitive advantage from a lower energy intensive process or product, as we've seen one of our companies do, then they're very keen to outline, to quantify that benefit and to get out on the front foot, and sell that into their customer base, and use that advantage and demonstrate that value. So, there are opportunities to be gained here. And then the last point is really on regulation. And I guess if it hasn't already become obvious, everything is coalescing around the same themes. What investors are asking for, how ESG ratings work, what customers and wanting from businesses, and the management of internal risks is really coming together under this sort of much more commercially aligned set of objectives. And if you just scroll forward under regulation, and this is just a paraphrase, really the sort of ethos of CSRD and IFRS sustainability, or in the case of the UK, what will be known as UK SRS, it asks for details on exactly these things. So the first one is the identification of what's important to us. And what we found through the materiality process, when people actually really look, considering all of those things we've talked about just previously on this webinar, and quantify them, then it really drills down into what they really need to manage. And then the remainder of the regulation steps through very classic change management techniques. Who's in charge in terms of responsibility? Where are we now in terms of what data do we have? Where do we want to get to in terms of targets? And then how are we going to get there in terms of a strategy, and ideally how much it's going to cost. So for once, regulation is actually sort of simplifying things. I think we've been in this era where we've had increasing regulation and demands which have kind of created more complexity. And actually, this is quite a breath of fresh air, because what we've seen with companies that we've worked with is that actually when you apply that strict materiality, you often find that you're cutting out the number of material kind of issues that you actually need to manage. And then putting together a comprehensive plan on that gives a very clear direction on what you should be doing. So as an organization, you have this kind of plan, you have a dashboard really in terms of tracking your progress to plan, and that's reported to the board because you've already identified that this is all financially important and they need to know about it. And it's also the core of your report for exactly those same reasons. So, largely, I guess, to summarize, where does that leave us? We get this question, a lot, which is what we should be doing. And I think the core of what a business should be doing in terms of managing sustainability is exactly that. It meets these regulatory requirements, and it largely hits those investor and customer expectations on the head at the same time. Unfortunately, as Chris said, we still do have to feed the beast in terms of data. That's still an important point. But I would reflect that largely companies have met those expectations already. They've set up the systems and the kind of measurements enabled to kind of to report that on a regular basis. So that doesn't necessarily have to remain part of the focus. It's just the annual sort of repeat work in order to satisfy reporting requirements. But the real juice is in following these core commercial requirements. So that's it from me. Ian, I hand over to you to take over.
Thanks, Jasper. So what's that mean then for your reporting and comms? What does one need to do with their disclosures, with their communications, to make sure that you're really facing into the future and reflecting where your stakeholders are going rather than just where they've been? And I think the most important point is to look at it as a communications ecosystem. This isn't about just shoving your data into a PDF, putting it in a dusty corner of your website. You need to look at every touch point that your stakeholders have, whether that's through the customer lens, whether that's through investor engagement, whether that's through internal comms, all of those different elements. Lots of stakeholders play multiple roles in your organization. They might be a shareholder and a customer. They might be an employee and a shareholder. You want to make sure that there isn't dissonance between the messages coming through each of those channels, because where you have dissonance, you break trust. Where you break trust, you break your license to operate. And indeed, there's quite a lot of research showing you also destroy financial value as well. So to drill down a little bit deeper down on these things, when we look at ESG, and we'll come to the terms itself in a minute, but historically, when I've interviewed investors on the ESG issues, the number one thing that comes up first tends to be governance, especially in the US, where pretty much, one investor told me directly, I am even looking at E&S through a G lens. Governance is the thing that, done right, can catalyze growth, make sure the right people are making the right decisions in the right place. It shouldn't be a dusty boilerplate piece. It should be a vibrant element of your entire strategy. So this question here was in PwC's latest Global CEO Survey, one of my favorite pieces of research that professional services companies put out. They asked in the past 12 months, they asked CEOs in the past 12 months, to what extent has your company experienced trust concerns from stakeholder groups? And you can see here on the right-hand side, the top three were data use and privacy, transparency, and AI. And specifically concerns about the safety or responsible AI. You might have seen in the news, one organization had an agent that destroyed the entire organization's database, including the customer data. So it's clearly an important value-specific metric. Those three are also ones, particularly data use and guardrails around AI, that are not well reported on right now in typical ESG reports. So they are probably areas that you want to focus on. If you are a little bit light in those areas, probably areas to bulk up fairly rapidly. That said, environment is not going away. If you listen to certain elements of the media, certain elements, particularly of the social media, you would believe that perhaps environment and climate specifically are declining in importance. That's not the case. Over half of FTSE 100 annual reports now have a specific transition plan or reference a specific transition plan. So clearly, certainly on this side of the pond, organizations are really thinking about what this means in the long term and how you can make sure that you protect and grow value. The second bit that we found interesting in our research was that over 2/3 of FTSE 100 annual reports now include nature-related disclosures. Nature is, of course, very difficult to compare and arguably impossible to compare between organizations. Nonetheless, 2/3 now are including disclosures around that key issue, biodiversity and nature-related issues. If it were that environment were declining in importance, one would expect that to be far, far lower, and that's the highest it's ever been. What about the US then? And that is really the elephant in the room. Even in the US, there are still a lot of disclosures. It is true, absolutely, that greenwashing is very much in evidence. Lots of the programs, lots of the activity, and some of the data that would have been disclosed only 2 or 3 years ago, it is no longer being disclosed. However, it is frequently the work is still frequently happening. It's just people are being a bit quieter about it. And there is a very good reason to disclose this stuff. As you can see here, researchers found that there's a 90% correlation between high ESG ratings and profitability. Now, that's not a causal relationship necessarily. Correlation isn't causation. Could well be that organizations that are well run, have high margins, generating cash, have got more money to spend on making sure that they're protective here. Nonetheless, if you want to give out signals of performance and that you're thriving, probably best not to get too quiet on these issues. And indeed, when the conference board reviewed S&P 500 organizations, they found that still almost 9 in 10 companies were disclosing climate-related targets, even in the US. I talked earlier about ESG as a term, and that has declined precipitously. I would expect that when this data is refreshed for 2026, it has declined even further. You can see from a peak of 40% of sustainability reports, including ESG, in the title of them in 2023. That was down to 10% last year. My suspicion is that that's now in single figures at best. And one of the things that our clients often ask us, in fact, it's one of the top two. The top two things that clients are asking us at the moment is, how do I streamline my report? What's genuinely material? What can I cut? And then secondly, if I'm operating across multiple jurisdictions, how do I square the circle between particularly the US and the European views? But obviously there are also differences in approaches in Asia and Europe, and indeed the UK and EU have a little bit of divergence too. And that's something that you really need to get a grip on, understand where your data are, understand what issues are important to your investors and other stakeholders. And that's really the key to really getting on top of it. So how do you do that? What do you do to really understand, particularly if you've got those multi-jurisdictional challenges? Well, the first thing is not to assume, to actually consult the data you've got, employee opinion surveys, AGM questions. all of those sources that you're listing out in your Section 172 statement. What does that really mean? What are your stakeholders really interested in, and how are you responding to that? You can use social listening, a really powerful tool to understand outside the media what people are really thinking. Lots of great social listening tools out there that you can use to get a real-time view on what people are saying and thinking about your organization. Of course, you should be engaging directly, interview investors. Generally speaking, investors like to engage with those they're investing in. Do engage with them directly. Ensure that you're really being responsive to their needs and avoiding any nasty surprises. Based on all that, refresh your reporting. And what I would say is really focus in on value creation. I think if there's been any big change over the past 18 to 24 months, it has been an increasing focus on where genuine financial value is created. In a way, it's almost like going back, 15, 20 years when sort of sustainability and corporate responsibility, as it then was really dialing up. Organizations were thinking, well, what are the ESG or corporate responsibility or sustainability factors that drive financial value? What are the ones that protect them? What are the ones that could damage them in the future and over the long term? Really focusing on value. And that's one of the ways to square the circle between the US and the UK. Politics will change. Political opinion will change. The inhabitant of 1600 Pennsylvania Avenue will change. What won't change is value. If you can demonstrate that all of this activity, even if it's in the things that Donald Trump doesn't like, DEI, inclusion and diversity, driving value through your people, if you can demonstrate value creation through those activities, it's very difficult to argue against. Make sure that you are building consistency across your channels, and that's particularly important in an AI world. It's no longer the case that a dusty old PDF will be the only channel that you'll need. And therefore, it's important to apply good practice from an AI perspective. The stats are quite stark. 60% of searches now are completely clickless, i.e., going to Google, I ask it the question, I look at the first page of results and possibly the summary if it's got one, and then I don't click anywhere else. I've got all the information I need without even clicking through into your website. If that AI overview is provided at the top of the box, then that clickless rate increases to 80%. When that's the case, only 1 in 5 people are actually going to your site. So actually, if you're not informing that summary, then there's a very real chance that your message isn't the one that's being delivered. It's somebody else's message about your issues. In annual reporting, one of the tools that people are using to solve that is an online annual report of some form. That doesn't mean a full end-to-end HTML report. They are, once you get past the top sort of 8 or so pages, very likely your traffic is going down to possibly even single figures of unique users. So I'm not saying for a second you should have like a 50-page HTML report, but you should have an online report with the top content. And over half of the FTSE 350 now have some form of online annual reporting. However, in sustainability, in ESG, it's much, much less. And that's going to be really important when we come into this AI piece, because if you don't have some HTML, there's a very real risk that it's not your content that's going to be served up. PDFs can be parsed by AI engines, by LLMs, and certainly if you feed it a PDF, it will come back with a pretty good summary of it. However, if you have just a general question, let's say I ask, is the organization planning properly for the climate transition? Then it will probably reference your PDF. But if that information is in HTML somewhere, even if it's not yours, it's likely to take the HTML first. So some simple tricks then to make sure that you are sort of getting that surfaced in the AI world. Structured data, meta tagging, absolutely important. Make sure that the engine can find your information. The best way to think about it is as a really smart 12-year-old, 13-year-old. If the really smart 12-year-old, 13-year-old could find that content, the engine probably will. And meta tags are the pieces of information that tell that bot what type of information they're looking at. Make sure your story and content is consistent, that you're not saying different things through different channels and different documents. make sure you've got summary boxes. If the engine finds a summary, it can grab that, not quite wholesale, but it will grab it quite easily. And as long as that is a good summary, it will also recognize that it's a summary of the PDF. It's consistent, and those engines love consistency. Really important to have descriptive titles within a PDF as well as outside a PDF. 5 years ago, it was very common that you'd have like strategy documents saying a sustainable future, or strategy pages, I should say. And an LLM will very likely misconstrue what that's talking about. It should be our strategy to a sustainable future. Just make it really plain what the engine is looking at, and indeed what a human is looking at as well. Optimize PDFs, make sure you've filled in the properties, make sure it's accessible. Accessible PDFs is a form of structuring the data, so as well as it being great for humans, it also helps the LLMs. And finally, really reinforce your credibility. Make sure you've got data references in, make sure you've got your methodologies, authors, links. Make sure that your communications ecosystem is robust. It's generally good reporting practice anyway, but hopefully that will help you in the AI world. With that, I'd like to go to Q&A. So I'm going to stop the share and have a look if we've got any questions so far. We do. We've got a question here of a breakdown of the attendees to this webinar. Bob, can I get you to email me a sort of rough breakdown of whether it's companies, consultants, etc., investors, analysts, etc., sort of very broad brush, and hopefully I'll get a response to that in time. Another question here: the science behind climate and nature crisis hasn't gone away. Completely agree. This is probably one for you, Jasper, or maybe you, Chris. Do the contributors see investors valuing a corporate's contribution to low carbon and nature positive transitions that have come in the medium or long term, or is it really about shorter term resilience and reputational risks only? Great question, thank you. Jasper, I might start with you.
Yeah, I mean, I think it's probably depends on the investor, and I know it's a bit of a cop out, but the reality is, I think most of them feel themselves to be long-term stewards in terms of their ownership. So really, they're looking out in the long term. And as Chris said, the couple of kind of examples that we've had that we've talked about were really about sort of, I mean, certainly, 5 to 10 years out kind of discussions, if not beyond that. So yes, the answer is essentially yes. Ultimately, I suppose, investors have two kind of ways of influencing companies. The first is through their sort of ongoing stewardship and engagement, and then if all else fails, to divest. But largely speaking, we're not seeing, and we haven't seen that sort of divestment trend. It's really a case of trying to work together with companies to try and kind of resolve issues, or at least create awareness and resolution of those. Chris, I don't know if you want to kind of pick up on that.
Yeah, I agree with that. I think just to set the scene for those who don't spend as much time with investors, the investment managers themselves, the people that run the money, are constantly being hit by macro or political or kind of other shocks that they are having to assess the opportunity and the threat, the risk associated with that particular bit of news flow. And because a lot of the money is driven by machines or by hedge funds, it does lead naturally to a very short-termist outlook for investors. And for the person who's asked the question, your IR, David, will be able to talk to you about this. But there's a situation where everything feels very short term. The two examples, as Jasper said, that we particularly picked out because they were much longer term questions in nature, and they were asked not in the form of a investor meeting at a time of results, but they came outside of that in a quieter moment, a combination of both the investment team and the sustainability teams within these large institutions behind them. One of them was in written form and then ended up a wider engagement. As I said, the second example is much more of a kind of like an interview with the company, which we at Sen participated in. But those are much more long-term orientated questions. So as Jasper said, it depends. But if you read the press or if you read the kind of what the management teams that you work for are hearing, they will just think it's very short-termist, very much about the next thing, Iran, interest rates, supply chain, whatever it happens to be. Whereas actually this community, it is a little bit longer term, but you have to listen quite carefully for it, and you have to really understand why they're asking at that particular time, if that makes sense.
Thanks, Chris. Um, Chris, I know you've got to run talk to your next meeting, so if you do need to jump at any point, please don't
Sure.
worry. We have got a few more questions in here. One here: if companies focus on financial value, does this not lead to higher greenwashing risk by reframing status quo business models as contributing to sustainability? I'll take that one if I may. I don't believe it does, as long as you've got a well-run company. If you are claiming the existing business model as a sustainable business model and it's not, you will be found out pretty rapidly. Might work in the short term, might work quarter by quarter, will not work in the long term. So you are exposing yourself to a greenwashing risk if and only if you greenwash. I think it's really that simple. Chris, Jasper, I don't know if you've got a different view.
I agree with that. I think, companies are absolutely focused on financial value. Boards and management teams ultimately are assessed in the short term by investors on how they perform. That is just, everyone should just take that as read, and this community should probably understand that if people think that's going to differ in any time short term, that's not going to work. That said, companies need to have an authenticity about what they do around their products, the way they operate, and the investment community has become more sophisticated, and they are asking, as we said, more exacting questions, and therefore you will be caught out by that community or another stakeholder who really understands what you do and why you're not actually living up to what you're saying. So I would say the gap has closed quite a lot around greenwashing. It's far less. The potential to do so is far less, and it's very, very risky if you do so and you get caught out. So, we've never advocated that, never would. Do what you say you're doing and do it properly.
Thanks, Chris. And of course, if you put that in your advertising, beware, very likely to be slapped down by the ASA. One question here: can you speak to the correlation between ESG ratings and share price? The piece of research that was from was the CSE 2025 annual ESG research. Search it; it's really useful research. That's the CSE 2025 annual ESG research. You'll find tons of answers there. It's really worth having a read. One last question, Chris, before you go, if I may. Do you see social factors growing in importance? Can often be focused on CSR, but will ratings agencies and investors look more at social value created through the business model?
I think social factors have always been important, even if they've not been pulled specifically out of kind of rating agencies analysis or investors kind of questioning. I think clearly for most companies, people still are the kind of key ingredient, the most important resource that they have. Is social value in itself going to be valued by investors? Well, if it has a positive outcome, then yes. But I think it's given there's been a dampening of the market around all of sustainability and ESG as we've alluded to, and people become more specific and become narrower. It's certainly a lot of these social factors directly have moved down the list, but they are just generally important. And I think we should just move. For me, it's moving away a little bit from it being kind of a separate segment. A lot of this just pervades everything the business does, both environmentally, socially, and in terms of the governance. People should be thinking about these things as separate issues, as part of integrated into businesses.
Thanks, Chris. Just to a couple of ones to wrap up. The answer to the question, attendees at this, it's about 80% corporates, about 20% investors and consultants. I can follow up with you later on with that if you need me to. And then finally, somebody asked, are companies moving away from sustainability reports to website disclosures? If so, what formats and what general points do they need to consider? The answer is right now they're not, and the PDF remains by far the most common way of disclosing sustainability and or incorporating within the annual report. And one of the challenges here is that sustainability budgets are often quite, quite tight, and you've got a lot to do with limited resources, and therefore finding extra for HTML, I know can be tough. But right now, organizations are not tending to move to full HTML for various reasons: complexity, searchability. People like to be able to download the PDF, Control F, find the information they need, and move on. But in an AI world, you will need to find some form of HTML, and having like an A to Z topics, having maybe part of the annual report, online report, would be a good way of solving that. Thank you everyone for your time. I know lots of people have got to move on. Thanks so much for sharing your time with us today. It's been really nice to speak to you all. If any of you want to follow up with any of us, please do so. I'm just finding my share button. You can reach, hopefully this should be sharing our contact details now. You can get in touch with me, iro@blacksonglobal.com, or chris.diet@sen-group.com, Group GRP. Do get in touch if you'd like to know more, or get in touch with your usual contact. We'd love to hear from you. Have a look at the website, contact us on LinkedIn. However you want to contact us, please feel free. We'd love to hear from you. Thanks very much for your time. Look forward to seeing you at another event soon, and have a fantastic day. Thank you very much. Bye-bye.